presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak Market Update. I'm Mo Ansari, President of Compak Asset Management and the host of Market Wrap. Thank you for tuning in today. Let's start with the supply chain issues. Today was an interesting day in the market. We did see some key reversals in the market. What does that mean? I'll talk about that a little bit later on when we take a look at the charts. But are we seeing the peak in inflation and starting to roll over? Is the Fed falling behind the curve? Again, I'll talk about that. A little bit about the global supply chain issues. Are we starting to unclog the supply chains? What about the bear market in stocks? We'll take a look at that. Is the bear market ending? Have we made a bottom? And then the weekly technical analysis and where we stand and the outlook ahead. Let's start with the supply chain. I talked about this on the daily edition of Market Wrap last week when I was talking to Vice Chairman of the Federal Reserve, former Vice Chairman of the Federal Reserve, Alan Blinder, and he said something interesting. He said about 8.5% inflation that we're seeing, 2.5% is because of the Fed. The other 6% is supply chain and oil prices. So let's take a look at supply chain first. You can see that this is the composite weekly implying bottlenecks, how they peaked out at the beginning of this year. And since then, we're starting to see a decline where we're starting to see the bottlenecks go away. If you look at the average score and it's well below what we saw at the end of last year. So we are starting to see the supply chain get a lot better, where we are starting to see the opening up or China reopening and supplies coming in. That's always good. Average time that the container is sitting in the St. Pedro port, that's the port of Los Angeles. We had it at the peak and now we're starting to come down again. Will we get back to February of 2020? Yes, we are halfway there now. We could get there in another few months. Same thing, the containers that they unload from the cargo ships, how long are they sitting on the port? One of the biggest problems you saw when we came out of COVID was we did not have enough truckers. We saw the containers being offloaded from the ships, but they were just clogging up the ports. We didn't have enough truckers because so many of them were laid off. We've got getting the truckers back, and we are starting to see the number of containers sitting for more than 5 days is starting to come down. What this is showing to me is that we are starting to see some unclogging of the supply chain. Are we there yet? Not quite, but we are getting there. Same thing with the door-to-door shipping. We were at a peak at the end of last year, beginning of this year, and it's starting to get better where orders are coming in faster. We're starting to see global lockdowns. Those restrictions are starting to go away. Looking at China, which is this red line right here, it peaked and they're starting to reopen finally. So that is why we're starting to see a lot more goods coming in, the supply chain untangling. Same thing we're seeing with a number of other restrictions. How about lockdowns, about people not to have to work from home. Those lockdowns are all coming down across the world. Let's talk about the stock market a little bit. Take a quick look at it. You can see the low growth potential, but not a recession. What happens then? You see current and where we're required by 2023, according to the estimate. So we're starting looking to all of this starting to look a lot better than where it was. We are starting to see rising rates have weighed on longer duration equities. That's when you look at bonds, most sensitive, we get shorter duration. You look at, and then you go to longer duration, which is long-term bonds. You can see that as interest rates go up, they have a much less of an impact on it. Looking at the technicals for the week, we are starting to see this is the 10-year yield. It had been going up, up, and up. And I talked about 3.2, which was the previous peak that we had seen in 2018. Well, we spiked above that for a few days, and then we came right back down and gapped down below here, leaving what I call is an island top in rates. And this was nearly 3.5%. We're down today to 2.8%. So we have dropped nearly 70 basis points since the middle of last month, which is a big, big drop. The bond market was telling us rates need to go up, and they were going up before the Fed raised rates. Now the bond market is telling us the economy is slowing. The Fed will continue to raise rates, but the bond market is telling us maybe the worst is behind us. We don't know that for a fact yet. As I've said, and I will show this to you when I do the weekly my quarterly webinar, which I will do next week. Couple of hours, we talk about the global economy, we take a look at interest rates, we take a look at impacts, take a look at last 50, 60, 70 years of history, when we have seen markets bottom, bear markets bottom, what are some of the signs. I'll talk about all of that on the 12th in the evening. So make sure you register for that by going to compak.com and registering for the webinar next week, and I'll answer your questions live. But we're starting to see these interest rates coming down, which is a positive sign. Everybody now is not worried about inflation today. The big news was, the economy is slowing. How much will the economy slow? Will we go into a deep recession? Will it be a shallow recession? We don't know that. A lot of that will depend on when inflation peaks and start to roll over. And when inflation starts to roll over, the Fed takes the foot off the brake. As soon as the Fed takes the foot off the brake, the stock market takes off. So today the market was looking at all of this data and saying, okay, we saw what is called a key reversal, where we went below Friday's low and we closed above Friday's high in the market, which is a good sign overall. If you look at today, we closed at 38.31, good sign. We're right close to the 20-day exponential moving average, which is right around 38.63. We closed at 30 points below that. And then we are getting close to this gap right here on the charts, which is about 4,017, gets filled. 50-day moving average now is 39.94. So if we can get up here about 4,000, that will be the next test. Also, this big downtrend line, this line that I've drawn all the way down here, you can see that that comes out somewhere right about here, 38.75 or so. So we're getting a good day today, a reversal day up, which is a sign of a turnaround in the market. We are seeing a fifth wave bottom. My target was somewhere around 35.90 to 35. We got just to 36.36. Got very close to, but that is showing a fifth wave bottom. So temporarily we could go up. We could continue moving up, but we need to get above 38.61, then get above 38.75, then above 4,000. If you can get above 4,000, that would be the first sign that there are some signs of life in the market. Otherwise, this is another bear market bounce so far that we're seeing. The daily crude oil chart shows us a negative, big down day today in the oil market, back below the 50-day, heading towards the 200-day, which is 98.50. 110 is the 50-day moving average. 200-day is 98.50. I think, again, oil prices have come down because of the fear of a recession now. That's what everybody is talking about. But we still have supply-demand issues where the demand is still exceeding the supply. Until we get that back in balance, either the demand has got to come down or the supply has got to go up. Right now, we still have demand, which is higher than supply, and that will continue to support prices in the short term. Gold market, big down day today. This was wave 1 to the downside, wave 2 to the upside, wave 3, wave 4 going up here. And now we're at the fifth wave. This is major support right around 1760. We close at 1763 today. So this is going to be support. If we break that, then we're looking at 1725 as the next target. Those are my views. Those are my observations today. If we can get close above last week's high, we get the unemployment data on Friday, I believe that's going to be the big driver on the market. Still the chance of a recession, 50-50. Wait till we get confirmation. As I always say on the daily edition of Market Wrap, don't forget that you want to see the bottom in the rearview mirror. Don't try to catch the bottom. Let the market make a bottom, start going up. You can see that was, let it go up, get through some resistance areas before you start putting money back into the market. Look ahead. This week we get the Fed meeting notes, and then on Friday is the big report, the unemployment report. Once we see unemployment start to go up, that's when people start really cutting back on spending, because as long as money is coming in, they say, yeah, I've got a job, I can still pay the credit card off. But as long as if we start to see some anxiety building, unemployment start to go up, that's when the consumer slows down. That's when the economy slows down. Those are my views. Those are my observations. Thank you for joining me today. Don't forget to tune in and join me for the 2-hour market webinar, global webinar that I will do on the 12th. You can go to compak.com and register today. See you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.